Not quite full porting FOMC. I don't think that's probably the best idea. I think there's good ideas in the world, but I don't believe that full porting FOMC is one of them. So let's get it, Team Bull. Trade smart, trade safe. Let's get to the money. We will be playing the meeting here in like 30 minutes too, when he starts speaking. We will be playing the meeting when he's speaking. I answer the one I can for sure. He starts speaking at 2:30 Eastern time. Yeah, we will be playing the meeting as well. Sometimes we'll catch a trade. It is higher risk though. Just so you know, anything I take is going to be higher risk. Just so you guys are well aware. If you're aware of that, and you take a trade size for that, then you know all the power to you. But just be aware, if we take any trades in the next 2 hours, or at least in the next hour, it's typically higher risk. So please, please, please just know that. We're streaming off FOMC, baby. That's why we're on. I'm not doing any bracket orders for FOMC. Nope, I am not. Not today. Sometimes for like CPI or something like that, but not for FOMC. 3 minutes until we find out we get a 25 basis points hike. Or a drop. Hike. No. If he hiked, can you imagine the market would die? Cut. I don't know why I said hike. If they hiked rates, oh my gosh. The market would literally collapse. Like, I'm talking, it would just be like decimation. Death candle, market limit down, market's closed, done for the day in about 10 seconds. Complete and utter destruction. All right, there we go. Good looks. Like completely destroyed. You short? Well, just be careful. We got 4, 3, or we got 1 minute left. Whoops. My computer's behind. Got 1 minute. Just kidding. False alarm. I will do my best to lead you to the victory land in the next 2 hours. Yep, Sawdog said it best. Reminder, you don't have to trade FOMC. You probably shouldn't, especially not right when the move happens. It blows accounts. That's correct. $15 seconds, y'all. Last chance if you're in positions to manage them. $50 basis points cut. Just watch it rip. Nothing yet. Probably 25 basis points cut. What a huge move, guys. A whopping 13 points. Oh, there we go. Now there's a move starting to come in. 25 basis points cut. A lot of it will depend on his tone. That's what I've been saying. Do I still trade the orb? Yeah. I mean, I mark my orb levels every day. You blew your funded? Well, why'd you do that? We moved like 40 points up and down. What's GC doing? Oh, yeah, gold did have a move down pretty aggressively. We can keep gold on too. We'll watch NQ and gold for power hour until he speaks. 25. I mean, everyone knew 25 basis points was coming. When everyone knows what's coming, it's not you're not going to get an aggressive move unless there's some sort of different dialogue in what he's saying. Let's see. We're pushing down, but I'm gonna wait for the dust to settle. See what we end up getting. I will not be caught in the chop. I just blew 10 funded's copy. Bro, why? How? Like, honestly, how and why? You blow accounts. I just don't get it. I just don't get it, bro. Like right now, if we close this candle weak, I'd almost always be looking for shorts, but I'm just not fully convinced right now until we get done with J Powell speaking or until we get some like real volatility moving in and we get some defined risk. So I'm just gonna stay patient. You know, I'm watching gold too. We got gold on the screen. We also have the NASDAQ. Where's our pre-market low? There we go. Gotta have that marked out too. All right. What do I recommend on funded next? Legacy or Rapid? Well, it depends. If you want a 1-day pass eval with capped payouts at the start, then Rapid. If you want an eval that has consistency on the eval, but no consistency on funded, and way more potential than you want to trade a legacy. If you've never traded funded next, remember that code Jdun25 gets you 25% off your first account, and then code Jdun gets you 15% after. Honest opinion about Tradeify, I love Tradeify. They just dropped 45% off too. Using code Jdun, as always, I always like to say that. I appreciate y'all supporting. I'll always do my best to help you and keep you motivated, keep you disciplined, keep you focused. Let's go, Yuval. Yuval's coming to the Halloween party at Team Bull headquarters on Friday. We're trading in costumes, baby. Let's go, Saw Dogs. Yes. Yep, and this is your reminder, above all else, choose discipline over dopamine today, guys. I don't want to see any heartbreaks at the end of FOMC because you over-leveraged, you got hosed. Whether it's FOMC, whether it's ABC, whether it's CDC, all I care about is DOD, baby. Discipline over dopamine. That's what matters. I choose discipline over dopamine. Stay focused, trade smart, trade safe. Micros are great. For example, today I traded very light size of micros this morning because I knew that there was higher risk and there was more chance of fuckery. Excuse my language. I knew there was more risk on, so I feel a lot better putting on a little riskier trades when I have less size. Yep. You think Powell going to cuck us today? It's possible. I honestly wouldn't doubt seeing high of day. Again, I say that we could dump and have the biggest down day we've had all year. I don't know. I'm just saying, with how the market's been, guys, you have to take in market sentiment. This market's strong. So unless he says some super dovish stuff, or if he says some super hawkish stuff that the market scares the market, then we might go down. But if he stays dovish, stays optimistic, if he doesn't basically say the market's going to die, I think this market goes up today. Now, if he comes out and he's saying anything at all that spooks the market and spooks or causes uncertainty, the market doesn't like that. Therefore, will likely fall, right? Not going to lie, that was a nice DOD plug. Usually you're such a dork, but that was bars, my friend. Hey, being dorky is better than being boring. Rather be dorky than boring. I can be a bit of a nerd at times, but at least I'm a rich nerd, right? Do you think the market already priced in the tax cut? Market doesn't give a crap about tax cuts or tax code. Cool rich nerd, I'm down. He used to, it's funny, in like middle school and stuff, people used to like make fun of being a nerd, being a dork, and now it's like, damn, those are the rich people. Nope. Apex's trailing drawdown is intraday. That's the only downfall of Apex, in my opinion. I still love Apex. It's still the most scalable firm. But you have to take into account intraday trailing drawdown as well. It is tough. Staying patient, guys. We got 20 minutes till interest rate decisions. This 40 contract long has me stressing. Well, no shit it has you stressing. I'm stressing thinking about you, my boy. This Powell's not speaking right now. Powell speaks in 20 minutes. Speaks at 2:30. That's so facts, SL Brett. That's so facts, bro. Bro, what did I tell y'all was going to happen this morning? The second I got off, market was going to fall. Do you see that this company Neo is releasing robots to do your dishes? You realize that? Life is going to be so insane in 2030. That is wild. I may or may not have put down a deposit for the 20 grand to own one. I will not confirm nor deny. Make a robot that can trade for you. That'd be so funny, trading with a prop from customer support. All right, Apex, I have a request. My robot took a trade for me. I need it voided. It wasn't me, it was my robot. So funny. Whoever's 40 contracts long is getting hurt. What's up, everybody? My dog ate my homework type she. Yes, that's exactly what it is. The gang. Be in Colorado. Come with a costume winning attitude. Dun. Well, let's see here. How do y'all people still fall for day trading? You must be new here, Adam. I recommend you come for a week. Watch me every morning. I bet I'll make you fall for it too. And before he says anything, it's going to be like, yeah, well, everyone fails. 95% of people will fail. So, like 5% of people get a six-figure job out of college in the first 3 years. trying to be a rich dork like Jdun. That's why I'm here rocking with Team Bull. I appreciate y'all. Yo, while we're getting ready for J Powell, make sure y'all like the live. We got 275 people here and 15 likes on YouTube. Come on, let's get that up to at least 50. Come on. Hit that follow button or hit that like button. If you're on TikTok too, tap that screen over and over. Let's get those likes up, baby. Come on, Spy. What's the best funded account for a beginner who wants to scale up and make money fast? You're already losing with that mindset, my boy. I'm not trying to be... here's the thing about me is I'll always be blunt, even if you don't like the answer. You're saying you're a beginner and you want to scale up and make money fast. That's a recipe for disaster. If you're a beginner, your goal should be learning a solid foundation and building a set system where you can consistently hit base hits and eventually make small money and then size up as you build confidence and make more money over time. That's the only way this works long term. Made $800 today as a sophomore in high school. Nice. That's dope. I don't own literally any XRP. Not a literal single dollar worth of XRP. Like literally none. And I'm 100% okay with that. I'm a Bitcoin millionaire. And I own no XRP. That'll definitely trigger someone. I should honestly have a red hat and a green hat. One for when I'm green, one red. We'd be wearing the green almost every day though. No trade ideas yet. I mean, I can't trade this right here. I own a lot of Bitcoin. I'm a big believer in Bitcoin. Big believer. And I got capital there to back it up. What's grandma thinking Powell's going to say? We should honestly ask her, Annie. Kind of goes against her edge. We usually ask her what way the market's going to go at market open. I wonder if her edge would work with FOMC. It's worth looking at, maybe. I use 5-minute primarily for entries. Primarily for entries. As a reminder, guys, I trade live every single day. Make sure y'all tap in. If you're on TikTok, hit that follow button. I'm also live on YouTube where you get full screen share. JDUN Trades, Jdun Trades on YouTube. If you're on YouTube already, we got an awesome community here. Our biggest stream is typically in the morning, but you can also open up your app and get full screen share of right now I have gold and NASDAQ up. So there's not really a lot going on in either. That orb reject on gold is pretty nasty. Powell about to release the candlestick of doom and despair. I just love Bitcoin. I'm just a Bitcoin optimist. Grandma probably been long gold since we were in diapers, right? What's up, bro? Hi. You get everything moved? Yeah. You're the man. Is he grinding on the carpet? Yeah. See, this is how y'all know I'm getting old. You guys have permission to call me Unk after this. I'm an adult getting all excited about my new carpet I'm getting today in my basement. Getting all new carpet in the basement. I'm all smiley, nitty gritty. Is that how it is getting old? You get like new carpet or you get like some new light fixtures or something and you're like, I'll feel all warm and fuzzy inside. Maybe that's just me. Maybe I am Unk. Maybe I deserve Unk status. I mean, right now, if I had to pick, obviously we have FOMC. The trend for the day is technically down. We made some lower highs, but I don't know, just with all things said and done, like unless he says something that really spooks the market, I still could see us ripping up 10 the day. I say that with no position on, so that means virtually nothing. New blinds. David said new blinds and carpet in the same month. Did Christmas come early? Right? No crap. So let's say we are to buy a dip, okay? Let's just go over some hypotheticals. Let's say we do want to buy... Oh, whoops. Did not mean to do that. On screen share. Say we do want to buy a dip today. We're at all-time highs. I think 26,100 to 26,000, like this aggressive impulse candle in here looks decent. That whole psych number. That's a 2 hour. Whoops. Yeah, I like that 26,100 area. If we're going to dip by today. Huh, server error. It's not letting me. It's like a dead account. I don't know. That's very odd. Never seen that before. That's weird. Well, I guess we just have a... Everyone's got to... got to be able to stand looking at see my page, but putting emojis. That's exciting. It's a little odd. I'm not sure why people spend their time doing that, but... So that's what I look for dip buy. And obviously, if we're looking for higher lows, we can find that in the lower time frame. I'm actually not up on the day currently. And I'm down like 177 from the 2 trades I took, so... Or correction, 274. Down 27, call it 275. We're small red on the day so far. But, I mean, it's basically break even. I took 2 little micro trades this morning. Is what it is, baby. Honestly, I didn't really like... I didn't really love what we were seeing with price action FOMC being later, so We got 4 minutes till the meeting, guys. Yeah, right. I mean, like this morning, for example, I just honestly didn't want to miss the move if I was trying it. I am gonna play the meeting. Yep. It's very rare I trade as small as I did this morning, but an FOMC day I will. And then gold's melting. Am I gonna go degen with you? No. But I will trade with you. I'm not degening. We get old done. Old done, baby. And this is your reminder too, guys. I'm just going to say this like 5 times during FOMC. Sorry if it gets annoying, but make sure to choose discipline over dopamine, guys. Please don't do anything stupid. If you're joining this meeting in Team Bull, I want you to remember that you're here for a reason. You're here to stay trade smart, trade safe, and stay patient. You're not here to gamble. You're not here to make dumb decisions. Stupid should not be your middle name. Can't hear you. Already full port of my unemployment check. Get the stimmies back, baby. Once the meeting comes on, guys, I'm gonna turn the music I have on off. It's not on yet. Oh yeah, it's weird. Elevator music starts coming on. That's who you know, and it's about to go down for FOMC. All right. Good afternoon. We have a dual mandate for the American citizens to make decisions based on the incoming data. Let's get it. It's on. It's just silent right now. Good afternoon.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Although some important federal government data have been delayed due to the shutdown, the public and private sector data that have remained available suggests that the outlook for employment and inflation has not changed much since our meeting in September. Conditions in the labor market appear to be gradually cooling, and inflation remains somewhat elevated. In support of our goals and in light of the balance of risks to employment and inflation, today the Federal Open Market Committee decided to lower our policy interest rate by 0.25 percentage point. We also decided to conclude the reduction of our aggregate securities holdings as of December 1. I will have more to say about monetary policy after briefly reviewing economic developments. Available indicators suggest that economic activity has been expanding at a moderate pace. GDP rose at a 1.6% pace in the first half of the year, down from 2.4% last year. Data available prior to the shutdown show that growth in economic activity may be on a somewhat firmer trajectory than expected, primarily reflecting stronger consumer spending. Business investment in equipment and intangibles has continued to expand, while activity in the housing sector remains weak. The shutdown of the federal government will weigh on economic activity while it persists, but these effects should reverse after the shutdown ends. In the labor market, the unemployment rate remained relatively low through August. Job gains have slowed significantly since earlier in the year. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. Although official employment data for September are delayed, available evidence suggests that both layoffs and hiring remain low, and that both households' perceptions of job availability and firms' perceptions of hiring difficulty continue to decline. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen in recent months. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index suggest that total PCE prices rose 2.8% over the 12 months ending in September, and that, excluding the volatile food and energy categories, core PCE prices rose 2.8% as well. These readings are higher than earlier in the year, as inflation for goods has picked up. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have moved up on balance over the course of this year on news about tariffs, as reflected in both market and survey-based measures. Beyond the next year or two or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by a quarter percentage point to 3.75% to 4%. Higher tariffs are pushing up prices in some categories of goods, resulting in higher overall inflation. A reasonable base case is that the effects on inflation will be relatively short-lived, a one-time shift in the price level. But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed. Our obligation is to ensure that a one-time increase in the price level does not become an ongoing inflation problem. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside. A challenging situation. There is no risk-free path for policy as we navigate this tension between our employment and inflation goals. Our framework calls for us to take a balanced approach in promoting both sides of our dual mandate. With downside risks to employment having increased in recent months, the balance of risks has shifted. Accordingly, we judged it appropriate at this meeting to take another step toward a more neutral policy stance. With today's decision, we remain well positioned to respond in a timely way to potential economic developments. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. We continue to face two-sided risks.
Well, there's a move.
Discussions at this meeting, there were strongly differing views about how to proceed in December. A further reduction in the policy rate at the December meeting is not a foregone conclusion. Far from it.
Ooh.
Policy is not on a precedent.
They're not committing to cutting again.
At today's meeting, the committee also decided to conclude the reduction of our aggregate securities holdings as of December 1.
Market's not going to like that.
The plan has been to stop balance sheet runoff.
At least in the short term.
Are somewhat above the level we judge consistent with ample reserve conditions. Signs have clearly emerged that we have reached that standard. In money markets, repo rates have moved up relative to our administered rates, and we have seen more notable pressures on selected dates, along with more use of our standing repo facility. In addition, the effective federal funds rate has begun to move up relative to the rate of interest on reserve balances.
We'll see how we react at 100 level. That was my main bounce. So we get down to 100. We'll see how we react.
Warrant today's decision to cease runoff. Over the 3.5 years that we've been shrinking our balance sheet, our securities holdings have declined by $2.2 trillion. As a share of nominal GDP, our balance sheet has fallen from 35% to about 21%. In December, we'll enter the next phase of our normalization plans by holding the size of our balance sheet steady for a time, while reserve balances continue to move gradually lower as other non-reserve liabilities, such as currency, keep growing. We will continue to allow agency securities to run off our balance sheet, and will reinvest the proceeds from those securities in Treasury bills, furthering progress toward a portfolio consisting primarily of Treasury securities. This reinvestment strategy will also help move the weighted average maturity of our portfolio closer to that of the outstanding stock of Treasury securities, thus furthering the normalization of the composition of our balance sheet. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting our maximum employment, bringing our inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Nick Timmeros from Wall Street Journal. Chair Powell, are you uncomfortable with how market pricing has assumed a rate cut is a foregone conclusion at your next meeting?
Well, as I just mentioned, a further reduction in the policy rate at December meeting is not a foregone conclusion, as I've just said. So I would say that needs to be taken on board. We had, just say this.
I feel like it's going to be a buy the dip type of day. It's just a matter of where.
Works very hard at this.
Finding where.
Obligations to serve the American people very seriously. And at a time when we have tension between our 2 goals, we have, strong views across the committee. And as I mentioned, there were strongly differing views today. And the takeaway from that is that we haven't made a decision about December. And, we're going to be looking at the data that we have, how that affects the outlook and the balance of risks. And I'll just say that.
You and some of your colleagues have framed last month, and maybe today, I won't put words in your mouth, as a risk management exercise. At what point do you conclude that you've taken out enough insurance? Are you looking for some kind of improvement in the outlook, or could this unfold along the lines of last year, where you made a sequence of adjustments and you waited to gather more information?
So the way I've been thinking about it is the risks to the 2 goals. For a very long time, the risk was clearly of higher inflation, and then that has changed now. And as we saw
no bounce down here yet for me.
We saw after the July meeting, we saw downward revisions of job creation. We saw a very different picture of the labor market, and suggested that there were higher downside risks to the labor market than we had thought. And that suggested that policy, which we had been holding at a I would say modestly, others people would say moderately restrictive level, needed to move more in the direction over time of neutral. If the 2 goals are sort of equally at risk, then you ought to be at neutral, because one of them's calling for you to hike and one of them's calling for you to cut. So if that got back into balance, then you'd want to be roughly at neutral. So in that sense, it was a risk management. And I would say the same about today.
There we go, Jerome, talking about risk management. He's one of us.
As I mentioned, going forward is a different thing.
Claire Jones, Financial Times. Thank you for taking this question.
Sounds like Anna Cooling.
We've just heard from you that the discussion in December and the conclusion of the discussion is not a foregone conclusion. I'd like to just dig into that a little bit more about what sort of arguments were brought up. Was there any consideration, for instance, of the investment we're seeing in AI and some of the generation of household wealth through rises in stock prices related to the AI boom? Thank you.
You know, I wouldn't say that's a factor in everyone's assessment of the economy. I wouldn't say it's the driving factor. I don't think for anybody. You know, I guess I would say it this way. Once again, I would just point out that we have the situation where the risks are to the upside for inflation and to the downside for employment. We have one tool. You can't do both of those. You can't address both of those at once. You've got a very different situation. So you have some people have different forecasts, right? So they'll
I've not taken anything, guys. I'm just watching.
Faster or slower progress on one or the other. And they also have different levels of risk aversion. And, you know, some will be more averse to inflation overruns and some will be more averse to underruns of employment. And so you put that together, and as you can see from the SEP and from the public discussion that goes on between the meetings when participants go out and talk, they're very disparate views, and they were reflected in strongly differing views in today's meeting, as I pointed out in my remarks. And that's what leads me to say that, you know, that we haven't made a decision about December. You know, I always say that it's a fact that we don't make decisions in advance, but I'm saying something in addition here, is that it's not to be seen as a foregone conclusion. In fact, far from it.
Can I just ask a quick follow-up on
Oh, this is the hourly.
How much of the
Whoops.
impressions we've seen in money markets?
I don't know why the hourly
related
was
to
up on
US
screen share. My bad.
Issue more short-term debt.
Yeah, that could be one of the factors, but the reality is we've seen, you know, the things that we've seen, higher repo rates and federal funds rate moving up. These are the very things that we see, that we look for. We actually have a framework for looking at, you know, the place we're trying to reach. What we said.
IWM is dying.
Is that when we feel like we're a bit above what we consider a level that's ample, that we would freeze the size of the balance sheet. Of course, reserves will continue to decline from that point forward as non-reserve liabilities grow. So this happened. Some things have been happening for some time now, showing a gradual tightening in money market conditions. Really, in the last, call it 3 weeks or so, you've seen more significant tightening, and I think a clear assessment that we're at that place. The other thing is, you know, the balance sheet is shrinking at a very, very slow pace now. We've reduced it by half twice, and so there's not a lot of benefit to be holding on to get the last few dollars, because, you know, again, with the balance sheets, the reserves are going to continue to shrink as non-reserves grow. So, you know, there was support on the committee as we thought about it to go ahead with this and announce effective December 1 that we will be, you know, freezing the size of the balance sheet. And the December 1 date gives the markets a little bit of time to adapt.
Colby. Thank you, Colby Smith with the New York Times. So much of the rationale for cutting interest rates, even
Still
as
looks
inflation
bearish right now
from
as far
the
as
2% target, seems
price
to be,
goes. We'll
you
see.
know,
I'll start looking for longs if we build a base around 26,000, or if we get some sort of nice 5-minute reversal candle with higher volume. Other than that, I'm just watching.
Change your perception of how much interest rates need to fall from here. Would you then be a bit more concerned about underlying inflation and the possibility of second round effects from tariffs?
Yeah, I mean, in principle, if you were to see data that suggested the labor market strengthening, or even that it's stabilizing, you know, that would certainly play into our decisions going forward. So, and we do have, you know, we get some data. The labor market is a place where we get, for example, we get the state level data on initial claims, which are sending a sort of a signal of more of the same. We also get, you know, job openings, and we'll get lots of survey data. We'll get the beige book and things like that. So we'll have a picture of what's going on in the labor market. And, you know, the fact that we're not seeing an uptick in claims or a downtick really in openings suggests that you're seeing maybe continued very gradual cooling, but nothing more than that. So that does give you some comfort.
But if this shutdown lasts a while longer and you don't have that data in hand, I'm just wondering how that hinders the committee's ability to assess the state of the labor market and make the right policy decisions, and also how much is that factoring into the debate about December?
Yeah. So, you know, we get like I mentioned what we get in the labor area. We get some data in inflation, some data in economic activity. And we'll have a picture of what's going on. We also will have the beige book again. I would say we're not going to be able to have the detailed feel of
Can finally
things, but
fulfill
I
her
think
dream
if
as a
there was
Walmart greeter, bro. That's messed
material
up.
change in the economy one way or another, I think we'd pick that up through this. So in terms of how it might affect December, it's really hard to say. December's the meeting's I guess 6 weeks away. We just don't know what we're going to get. If there is a very high level of uncertainty, then that could be an argument in favor of caution about moving. But we'll have to see how it unfolds.
Steve.
Steve Leisman, CNBC. Mr. Chairman, can you characterize the meeting in terms of, you said strongly differing views? Was this a close call, this cut, or was it a close call maybe the other way because you had dissents on both sides? Thanks.
So I was referring to the discussion about, to the extent it related to December. You saw we had two dissents, one for 50 and one for no cut. So that was a strong, solid vote in favor of this cut. The strongly differing views were really about the future. What does that look like? And I think people are saying, they're noticing stronger economic activity. Forecasters generally, broadly, have raised their economic growth forecasts for this year and next year, in some cases, quite materially. In the meantime, we see, a labor market that's kind of, I don't want to say stable, but it's not clearly in motion. It's not clearly declining quickly in any case. It may be just continuing to gradually cool. And again, people have different forecasts and expectations about the economy and different risk tolerances. And so there's you read the SEP, you read the speeches, there are different views on the committee, and to the point where I said what I said.
Just to follow up on the balance sheet, if you stop at the runoff now, does that mean you have to go back to actually adding assets sometime next year so that the balance sheet doesn't shrink as a percent of GDP and become a tightening factor?
So you're right. The place we'll be on December 1 is that the size of the balance sheet is frozen. And as mortgage-backed securities mature, we'll reinvest those in treasury bills, which will foster both a more treasury balance sheet and also a shorter duration. So that's what, in the meantime, if you freeze the size of the balance sheet, the non-reserve liabilities, currency, for example, they're going to continue to grow organically. And because the size of the balance sheet is frozen, you have further shrinkage in reserves. And reserves is the thing that we're managing that has to be ample. So that'll happen for a time, but not a tremendously long time. We don't know exactly how long. But at a certain point, you'll want to start reserves to start gradually growing to keep up with the size of the banking system and the size of the economy. So we'll be adding reserves at a certain point, and that's the last point. Even then, we didn't make decisions about this today, but we did talk today about the composition of the balance sheet, and there's a desire that the balance sheet be right now it's got a lot more duration than the outstanding universe of Treasury securities, and we want to move to a place where we're closer to that duration. That'll take some time. We haven't made a decision about the ultimate endpoint, but we all agree that we want to move more in the direction of a balance sheet that more closely reflects the outstanding treasuries, and that means a shorter duration balance sheet. Now, this is something that's going to take a long time.
Let's see what they give us here.
Gradually, I don't think you'll notice it in market conditions, but that's the direction of things.
Janelle Marte with Bloomberg. How are officials interpreting the latest CPI report? So some components came in lower than expected, but core inflation was still at 3%. So at this moment, what are you learning about the drivers? And also, do you view that the risks are greater that the Fed makes a mistake on employment or inflation?
So the September CPI report, we didn't get PPI after that, which is important for translation into what we look at, which is PCE inflation. But we can still make a pretty good assessment of what that will be. When we get PPI, there might be some adjustments. But so directionally, it was a little softer than expected, and we always break it down into the three components. So basically, you've seen goods prices increasing, and that's really due to tariffs. And that's compared to a longer run trend of very, very mild deflation in goods. So that's moving inflation up. On the other side of that, good news that housing services inflation has been coming down and is expected to continue to come down. So if you remember a couple of years ago, that's the one that we kept expecting it to do that. Now it's been doing that for some time, and we expect to continue that. That leaves the biggest category is services other than housing services. And that's kind of been moving sideways over the last few months, but a significant part of that is non-market services, and we don't take a lot of
Gold's hurting too.
the tightness of the economy from that. So if you add all that up,
Let's see.
a couple things to say. One is that inflation away from tariffs is actually
What?
not so far from our 2% goal. We estimate
in a little
people
bit.
have different estimates
Thank
of
you,
what
bro.
that is, but it might be 5 or 6 tenths, and so that if it's 2.8, then core PCE not including tariffs might be 2.3 or 2.4 in that range, something like that. So that's not so far from your goal. So that we look at that, and the thing about tariff inflation is the base case is that it will come, and it probably will increase further. But it is that it will be a one-time increase, and we've been very focused for all of this year at making sure that that's the case, and thinking carefully about what are the pathways through which it could become something else, troublesome inflation. One of those would be, a really tight.
Yeah, I didn't get the 26,100 bounce.
Could be inflation.
Didn't have the
expectations from
volume
the
confirmation I wanted.
So I think we're watching this very carefully. I think it's not the case that we're just assuming that it's going to be a one-time inflation. We understand fully this is a risk we have to monitor and ultimately manage.
With the stubborn in services inflation, what are some of the things that the Fed could do to address that? And especially when we're seeing potentially labor supply challenges.
Sorry, say the first.
The stubborn services inflation that you mentioned.
Service inflation. Okay. Well, again, the part of services inflation that isn't coming down as we would like it to is the non-market part of non-housing services. And overall, that's.
So, your reminder: discipline over dopamine, guys. Don't do anything silly.
Non-market part of it should come
Choose
down.
DOD.
It reflects higher stock prices.
I know it's FOMC, but I want you to choose DOD instead.
That are imputed.
Trade smart, trade safe.
Paid is a big part of that. But also just, we think policy is still modestly restrictive in my telling. So that's the kind of thing that should lead to a gradually cooling economy. That's one of the reasons you see a gradually cooling labor market is because, the Fed policy is modestly restrictive. So that should also help get that. I want to say, though, we're absolutely committed to returning inflation to 2%. If you look at longer-term surveys or market pricing, you will see that's a credible commitment, and there should be no question that that's where we're going.
Chris.
Great, thank you. Chris Freegaber at Associated Press. So there's a big investment boom in AI infrastructure right now, as you know, and wondering if the existence of such a boom would indicate that rates are not that restrictive after all, and could further rate cuts at this point perhaps fuel an excess level of investment there or market bubbles? How is the Fed thinking about that?
So I don't think that you're right. There are a lot of data centers being built and other investments being made around the country and around the world. Big U.S. companies are just investing a lot of resources in thinking about how AI, which will be based on those data centers, run through those data centers, is going to affect their businesses. So it's a big deal. I don't think that the spending that happens to build data centers all over the country is especially interest sensitive. It's based on longer run assessments that this is an area where there's going to be a lot of investment and that's going to drive higher productivity and that sorts of things. I don't know how those investments will work out, but I don't think they're particularly interest sensitive compared to some of the other sectors.
And then just a quick follow-up. You mentioned that you do have data that you're looking at for inflation and growth in the absence of government data. Could you give us a sense? I think we know a lot about the jobs data that's out there. Can you give us a sense of what you're looking at to track inflation in the absence of government data? Thank you.
So it's a lot of things, and it doesn't replace government data, but you know all of these. I'll just mention some of the many names: Price Stats, Adobe, and others. For wage inflation, there's ADP data. On spending, you're going to ask about spending at some point. There are lots of other things that we look at, but it's many different sources, and again, including what we get out of the beige book, which will be sort of come out.
See what we do with this 200.
And it doesn't.
It's halfway looking for a short entry if we confirm this candle low, but not fully sold yet.
Material were happening. If there were material developments, I think we would pick that up. I don't think we'll be able to have the very granular understanding of the economy while this data is not available.
Howard Schneider with our Reuters. Thank you. I just wanted you to elaborate a little bit on what you said a moment ago about the a continued shutdown, making it more difficult to make a move in December, and that may make you more cautious. To the degree you are relying on private data that isn't the gold standard, or that you're relying on your own surveys or the beige book, do you worry at some point you're going to have to start making policy by anecdote?
This is a temporary state of affairs, and we're going to do our jobs. We're going to collect every scrap of data we can find, evaluate it, and think carefully about it. And that's our
Gold
job.
is rebounding.
If you ask me, could it affect the December meeting? I'm not saying it's going to, but yeah, you could imagine that what do you do if you're driving in the fog? You slow down. So that could or could not. I don't know how that's going to play into things. We may get the data may come back, but there's a possibility that it would make sense to be more cautious about moving. I'm not committing to that. I'm just saying it's certainly a possibility that you would say we really can't see, so let's slow down.
As a follow-up in the debate on this meeting, we saw recently some pretty big layoff announcements coming from Amazon and others. Wondering if that figured into the discussion at all, that you're starting to see this tension between growth and employment starting to be resolved, to the detriment of employment. And secondly, some of the stress is starting to appear in the bottom spur of the K, as they call it, household health premiums that are going to possibly be going up quite substantially, things like that. Has that started to become a factor in your policy discussion?
So those are both things that we're watching very, very, very carefully. To start with the layoffs, you're right. You see a significant number of companies either announcing that they are not going to be doing much hiring or actually doing layoffs. And much of the time they're talking about AI and what it can do. So we're watching that very carefully. Yes, it could absolutely have implications for job creation. We don't really see it in the initial claims data yet. Now, it's not a surprise that we don't. It takes some time for it to get in there, but we're watching that really carefully. But again, don't see it yet in the initial claims data. On the K-shaped economy thing, I would say the same thing or similar thing. We are if you listen to the earnings calls or the reports of big public consumer-facing companies, many of them are saying that there's a bifurcated economy there, and that consumers at the lower end.
Let's see. We got a reversal candle, but not fully sold yet. We'll see.
But that
I'm watching.
People are spending at the higher income and wealth, and they're so much anecdotal data on that, and so we think there's something there.
Edward.
No trades for me yet.
Thank you, Edward Lawrence with Fox Business. So, Mr. Chairman, I want to take another crack at the further reduction in rates is not a foregone conclusion. So in December, he said, far from it. So if a cut might not be on the table for December because of lack of data, what does the other concerns then stem from? So if it's not lack of data, as the reason December is not a foregone conclusion, what other things could be the concern then?
Well, the perspectives of people on the committee that we've now moved 150 basis points, and that we're down into you're into that range between 3 and 4, where many estimates of the neutral rate live in that 3 to 4% area. You're there now. You're above the median number for the committee, but I think there are people on the committee who have higher estimates of the neutral rate, and that's you can argue these positions since it can't be directly observed to neutral rate. So, I think for some part of the committee, it's time to maybe take a step back and see whether there really are downside risks to the labor market, or see whether in fact the growth that the stronger growth that we're seeing is real. Ordinarily, the labor market is a better indicator of the momentum of the economy than the spending data. That's the lore. In this case, that gives a more downbeat read. So people just have, we've cut.
Damn, that short century would have been it.
In the last 2 meetings, and there's
Oh, well.
sense like let's pause here, kind of thing, and a sense from others wanting to go ahead. But that's why I say differing views, strongly differing views.
And so on that division, then you're talking about going forward. So what's more important in this division? Is it inflation risks? Is it employment risk? Or is there a deeper philosophy division among the board?
I look, everybody on the committee is deeply committed to doing the right thing to achieve our goals, maximum employment and stable prices. You have differences on how to do that. And as I mentioned, some of that is different forecasts, but a lot of it is also different risk aversions to the different variables, which is common through all Federal Reserves. People just have
Low key call out? No.
Let's say. So that leads you to people with disparate
I speak through my thoughts, but
from the speeches you've been listening to from Mike.
no, I didn't call anything out.
And
I like
so
the
we're
shorts. I
close
didn't
now
take them
where
though.
We have in fact cut 2 more times, and we're 150 basis points closer to neutral, wherever that may be, than we were a year ago. And so there's a growing chorus now of feeling like maybe this is where we should at least wait a cycle, something like that. That's what it is. It's just what you think it would be. It's and again, you've seen it in the September Summer Economic Projections. You've seen this in the public remarks of FOMC participants, and now I'm telling you that's what you can expect that in the minutes, and I'm just telling you that's what happened in the meeting.
Elizabeth. Thank you so much. Elizabeth Schulze with ABC News. What is your explanation for why the job market is weakening right now, and what will this rate cut do to improve the job market?
So I think there are 2 things affecting the job market, and one of them is just a dramatic reduction in the supply of new workers. And that's 2 things. That's declining labor.
Hey, Brandon
force
killed that short century in Team
which
Bowl.
is a cyclical thing, and then there's
On the
declining
admin
immigration,
floor.
which is just a big policy change that actually began in the last administration and has been accelerated now. So a big part of the whole story is that supply side story. Okay. In addition, labor demand has declined, and the unemployment rate has gone down, meaning that demand for workers has gone down a little more than supply. So that's what's going on, but it is mostly a supply function. It's mostly a function of the change in supply, I think, and many people think. So the question then is, what does the our tool do, which supports demand? And and I would just say, when you're in a situation where job
214,
creation, if you adjust for likely
4.
overcounting in the way that BLS does its work, is pretty close to 0. So maximum employment doesn't, on a sustainable basis, if you're creating 0 jobs, if it's in equilibrium, if it's in balance, it's a pretty, as I said before, a pretty curious balance. So, I thought, and many of my colleagues thought, in fact, you've seen the last 2 meetings, that it was appropriate for us to react by supporting demand with our rates, and we've done that. We've reduced so that rates are looser. I wouldn't say that they're accommodative right now, but they're meaningfully less tight than they were, and that should help, so that at least the labor market doesn't get worse. So it's a complicated
Let's
situation.
see. We got 1 more hour.
Some people argue that this is supply, and we really can't affect it much with our tools. but others argue, as I do, that there is an effect from demand and that we should use our tools to support the labor market when we see this.
Just waiting on our
You also
setups.
talked about tariffs causing a one-time price increase. Should American household consumers expect that inflation will continue to go up this year because of those tariffs?
So the basic expectation is that there will be some additional increase in inflation because it takes a while for tariffs to work their way through the production chain and finally get to consumers. And we see this now from the tariffs that were put in place now many months ago. We see those effects, but if you put tariffs in effect, and they've been coming into effect consistently in February, March, April, May, and that's all happening. So that'll continue to happen for some time, probably into the spring. These are not big increases, though. These are a tenth or so on inflation. They may be big increases on a particular product that's been tariffed, but overall, these are fairly modest. I think some projections go we're at 2.8% inflation. You might get 2 or 3 more tenths or 4 more tenths maybe. But then, as all of the tariffs are in, they stop generating inflation. You've had a one-time price increase. As long as you're not, at least this is the theory. This is how we believe and hope that it will work out. Once the last tariff is put on something, at that point, it becomes a higher price level, but it stops going up, if you will. Prices stop going up. They'll just be at that level. And then measured inflation will come back down to non-tariff inflation. As I mentioned, non-tariff inflation is not so far from 2% now. Now, consumers are not interested in that story. Their prices are higher. More than that, the reason they're so unhappy about inflation is the inflation that we had in 2021, 2, and 3. Because, you can say that prices aren't going up as much, but that doesn't mean people aren't feeling those higher prices from the inflation we had 2 or 3 years ago. They are, and that's, I think, a large part of why the public, if you sample people, inflation is still very much making people quite unhappy. Even, and it's nice that, that prices are not going up as fast as they were, but they're still much higher than they were. And it'll take some time for that effect to wear off. As real incomes rise, it will feel better over time, but that's going to take time.
Michael McKee from Bloomberg Television and Radio. Do you have any concerns that equity markets are or are close to being overvalued at this point?
Well, this guy's got puts.
We don't look at any one asset price and say, hey, that's wrong. It's not our job to do that. We look at the overall
He's like, please say yes.
Financial system, and we ask whether it's stable, whether it could withstand shocks, right? So, banks are well capitalized, while some households are clearly under stress. In the aggregate, households are in good shape financially, relatively.
Households are in good shape. That's just not true.
Levels of debt. At the lower income spectrum, you are seeing rising defaults, particularly around subprime auto, but nonetheless, in the aggregate, pretty good. You don't see too much leverage in the banking system or the financial system. It's a mix.
Your houses are in good shape. Who? What houses? Who's he talking to? Not anyone that I talk to.
We don't set asset prices. Markets do that.
Well, you must be well aware that by lowering interest rates, you're contributing to additional
This is your reminder for discipline over dopamine, everybody.
And I wonder how you balance the
Please trade smart, trade safe, stay focused.
labor market with the reality that it seems more likely to be stimulating increased.
Yeah, someone is BlackRock. They've been asking BlackRock how things are.
For thousands of job cuts that have been announced in the last few weeks.
Yeah, I don't think interest rates are an important part of the AI of the data center story. I think people think they're great economics in building these data centers, and they're making a lot of money building them, and they think they have.
And my house is happy given the new carpet coming in.
It's not
funny.
About 25 basis points here or there. We use our tools to support the labor market and to create price stability. That's what we do. That's our two jobs, right? So we're here by lowering rates at the margin, that will support demand, and that will support more hiring. And that's why we do it. Now, no 25 basis point or even 50 basis point hike is going to be a dispositive thing, but ultimately, lower rates will support more demand, and that'll support hiring over time. And of course, we also have to be careful about this, which is what we've been doing because we know where inflation is, and we know that, I've told you the story. It's a complicated story, but this is the best assessment that we can make. Because there's uncertainty around inflation.
Thanks for the DoD reminder. You're welcome. I got you.
The pace we're going has been a careful one.
Here's another one. Choose discipline over dopamine. Don't full port. Don't do anything stupid. We're going to get some good movement tomorrow.
Hi, Victoria Guida from Politico. On AI, I'm just wondering, it seems like a lot of the economic growth that we've been seeing is fed by investments in AI. So how worried are you about what a sudden contraction in tech investment would mean for the overall economy? Is there enough strength in other sectors? And specifically, are there any lessons that you take from the 1990s in how you might approach what's happening right now?
Yeah, this is different in the sense that these companies.
I'm watching it on YouTube, Federal Reserve.
Actually have earnings and stuff like that. So if you go back to the 90s and the .com, these were ideas rather than companies, and so there's a clear bubble there. Whereas I won't go into particular names, but they actually have earnings, and it looks like they have business models and profits and that kind of thing. So it's really a different.
Yep, we also have big earnings tonight as well. Some big earnings.
The investment we're getting in equipment and all those things that go into creating data centers and feeding the AI, it's clearly one of the big sources of growth in the economy. Consumer spending also, though, has been, is much bigger than that and has been growing and has defied a lot of, negative forecasts, continuing to do so this year. Consumers are still spending. Now, it may be mostly higher end consumers or maybe skewed that way, but the consumer is spending, and that's a big chunk of what's going on in the economy, substantially bigger than AI. You could point to growth. I mean, actually, you may be growth as opposed to level, but consumer spending is a much bigger part of the economy.
And why do you think that the labor market is slowing so much, even though consumer spending is strong?
Why has it slowed so much? Well, what's happened is that the supply of workers has dropped very, very sharply due to mainly immigration, but also lower labor force participation. So, and that means there's less need for new jobs because there isn't this flow into the pool of labor that where people need jobs, because there aren't those people now. So there's not a supply of workers showing up for jobs. In addition, demand has also gone down, and so has labor force participation has declined, which is more of a sign, in this case, of demand as well as trend. So I think you're seeing some softening. The economy's growing at a slower rate than it was, 2.4% last year. We think around 1.6% this year. It could have been a couple of tenths higher if not for the shutdown. And of course that will reverse. But, you still got the economy growing at a moderate pace.
Andrew.
Hey there, Andrew Ackerman with the Washington Post. I wanted to ask if you could elaborate on how you think about policy in the context of the data drought. Does it make you inclined to stick with your plans as set out in September in the absence of the data that might change your mind, or does it make you inclined to proceed with added caution because of uncertainty?
Yeah, well, we'll know when we face that question, if we face that question. It'll probably be argued both ways, right? But I've said a couple times here that, if you really aren't getting information you really don't know, and the economy looks like it's solid and stable and hasn't really changed, there will be an argument. I don't know how persuasive it will be, but there will be an argument that, you slow down when you can't see as far ahead. Others may argue, I'm not sure where this argument will come, but you're perfectly right that you could also argue, well, things haven't really changed, but you might not know that, so I don't know whether we'll face this or not. I hope we don't. I hope by the time of the December meeting, we're getting, a better flow of data, but if we're going to have to do our jobs one way or the other.
Okay, I also just wanted to ask a FinReg question. I think several years ago you said the overall amount of capital in the system was about right. As the Fed moves forward with a revised Basel proposal, potentially changes to the GSIB surcharge, has that changed at all? Or are you planning to significantly reduce the amount of capital in the system? Thanks.
So there are discussions going on, I think, among the agencies, and I don't want to get ahead of those discussions. I continue to think that the level of capital when I said that in 2020 was about right. And of course, there's been much capital added since then through various mechanisms. But I look forward to I know those discussions are really just getting going. They haven't come to the point where they're got a whole plan and that kind of thing. So I really don't have much to say on that.
Hi, Chairman Powell. Brian Chung with NBC News. Is the weakness in the jobs market accelerating, and who's at risk if the interest rate cuts are not the effective medicine for a further slowdown?
So we do not see the weakness, as you put it, the weakness in the job market accelerating. I would say, and again, we didn't get the September employment report, payroll report, but we look at, the unemployment insurance claims, initial claims are reported at the state level, and we still get those, and we can accumulate them and get the national number. And there's really, no story. You can look at the numbers. Same thing with the job openings we get from Indeed. There's just no story over the last 4 weeks. It's kind of stable. So you don't see anything that says that the job market is, or really any part of the economy is making a significant deterioration. Don't see that. You see more things like I mentioned, though, which is that, you see big companies making announcements of either of layoffs or of the idea that they won't need to hire. Their number of employees is not expected to go up over a number of years. There may be different people working there, they say that too, but they don't need a bigger head count. So you see those kinds of things. You don't see it in the aggregate numbers. The layoff numbers have not gone up, but job creation is very low. And the job finding rate for people who are unemployed is very low. But the unemployment rate is very low as well. 4.3% is a low unemployment rate.
So as you make these cuts, is it the lower income workers that you're thinking about, or those who might have their jobs automated? Is there a particular section of the labor market that you're particularly?
So we can't, our tools don't allow us to target any demographic or any income level, that kind of thing. I do think that people, we saw this during the global financial crisis and the long recovery. If you have a long period of very strong labor market conditions, it benefits people at the lower end the most. The last 2 or 3 years of that long expansion, people at the lower part of the income spectrum were getting the biggest benefits, and lots of things were happening in that space demographically, which were very constructive. And
40 more minutes of Power Hour, everybody. Trade smart, trade safe, choose discipline over dopamine, and stay focused. If you're on this live with me, you're staying focused.
For the public, it's also part of our job. It is half of our job, but it is absolutely the best thing we can do for people. Along with keeping prices stable, those two things. Inflation also hurts people on fixed incomes more than other people.
Courtney. Hi, Chair Powell. Courtney Brown from Axios. As you know, the 12 Reserve Bank presidents' terms are up for renewal at the end of February. I'm wondering if you can give us a timeline for when the board will consider those reappointments, whether we can expect everyone to be re-upped or if we can expect some changes.
So it's a process that we go through under the law. The way the law works is we have a reappointment process every 5 years for all of the reserve, each of them and all of them. We're in the middle of that process, and we're going to complete it in a timely way. And that's really all I can say.
Okay, thank you.
Daniel.
Daniel Davis, Agence France Presse. You've now had dissents in 3 consecutive FOMC meetings, but in this meeting you had dissents going in both directions. And you've just mentioned there's strong disagreement over the future path of rate cuts. Have these disagreements complicated your role presiding over the FOMC meetings? And if so, how?
I wouldn't say that, no. I think you have to take what comes, and what comes right now is a pretty challenging situation where we have.
Yeah, we're just gonna have DOD reminders every 5 minutes. Discipline over dopamine. Discipline over dopamine. Discipline over dopamine. Every day.
Overall, it's a good picture. It's a good picture, but in terms of our policy, we have upside risks to inflation, downside risks to employment, And this is a very difficult thing for a central bank because, one of those calls for rates to be lower, one calls for rates to be higher. We can't do both. So we have to balance the two. And so it's a challenging thing. And, as we have worked our way through this process, you would expect that there will be a range of views across the committee on what to do and the speed with which we should do it. And that's what we have. That makes a lot of sense to me. All of these people are, people who take their jobs very seriously, work very hard at this, and just want to do what's right for the American people. But they have different views on what that is. And, it's an honor to work among people who care that much. It is, but I don't feel that it's unfair or anything like that. It's a time when we're making quite difficult judgments in real time. And I believe we'll get through this. And I think we've done sort of the right thing so far this year. I think it was appropriate for us to be careful about this. I think it would not be appropriate to just ignore or assume away the inflation issue. At the same time, I think the risk of higher, more persistent inflation has declined significantly since April. And if we do wind up resuming rate cuts at some point, we will at some point. I think we're trying to get to the end of this cycle with the labor market in a good place and with inflation, on its way to 2% or at 2%. So that's all we're trying to do, and we're doing it under, quite challenging circumstances and doing the best we can.
We'll go to Jennifer for the last question.
Thank you so much, Chair Powell. Jennifer Schonberger with Yahoo Finance. Both regional and large banks have taken losses on loans given delinquencies on subprime auto loans. JP Morgan CEO
Hey, let's go.
When you see one cockroach, there may be more likely. I'm curious how the Fed is looking at these loan losses and if it poses
We're gonna get
risks
one of those
to the
next.
financial system or the outlook for the economy. Is it a warning sign?
So, we're obviously we watch these things very carefully, credit conditions very carefully. You're right. You've seen rising defaults in subprime credit for some time now, and now you've seen a number of subprime credit, automobile credit institutions having significant losses, and some of those losses are now showing up on the books of banks. We're looking at it carefully. We're paying close attention. I don't see at this point a broader credit issue. It doesn't seem to be something that has very broad application across financial institutions. But we're going to be monitoring this quite carefully and making sure that is the case.
And then separately, many, you yourself have said that we're in a bifurcated economy right now with high net worth individuals continuing to spend with the lower income pulling back. How much of consumer spending continuing hinges on the stock market remaining strong? In some way,
she's
does the
got
market
the
help
puts.
keep the economy buoyant?
So there's some relationship there, but remember, the more wealth someone has, the lower an additional dollar of wealth matters. So your marginal propensity to consume declines quite dramatically as you reach levels of stock market wealth. So, the stock market it would affect spending if the stock market went down, but it wouldn't drop. It wouldn't drop sharply unless there were quite a sharp drop in the stock market.
It wouldn't drop sharply unless there was quite a sharp drop. That's got to be some Mozart shit right there. That is poetic. It wouldn't drop sharply unless there was a sharp drop. You really killed that one, J. Powell. That was poetic, my guy. That didn't even make any damn sense. It might be red. It might be wet if it's raining water outside. Thanks, bro. That was very, very informative. Oh gosh. And then we're gonna end on that. Walk away. That's wild. All right, boys and girls. Still time to choose discipline over dopamine. Trade smart, trade safe, and let's wait for an A+ setup. Let's see what we do at this pre-market high and 15-minute low. Let's get my music back on. Didn't tell us anything we didn't already know. Yeah, I think I lost a few brain cells listening to that for sure. Definitely thought I lost a few brain cells. Well, I hope you chose discipline over dopamine. But if you didn't, if you went against Mr. Jdun speaking to you, You can get a new funded account with multiple firms. Right now, the best deals are with Tradeify with code Jdun for 45% off all straight to funded accounts besides the 150Ks. And Funded Next, if you're a beginner or want some cheaper accounts, the legacies have no consistency rule. In addition to no payout cap, no scaling rules, no daily loss limit, no monthly fees, no activation fee, and withdraw 50% of your profit after 5 days. That is nuts. So if you need an account, nope, this new Funded Next account is not a subscription, which is great. You can use code JDUN25 if you've never used Funded Next for your first account. If you have gotten an account, you can use code JDUN for 15% off. It's honestly an insane deal. It ends on the 31st. Bought a Funded Next account with your code last night. I appreciate you. Alpha Futures is really good too. I used your code with Alpha. I appreciate you. Yep, Alpha Futures is good too. If you're on Alpha Futures, code JDUN always gets you best discount as well. If you guys fumbled your bag and need an account to choose discipline over dopamine with, there you go. Lots of firms way better than MFF. Well, if you didn't listen to DOD and just blew your account, you can use code JDUN to get a new account. It's true. I tried to save you. But if you didn't save yourself, get a new account with JDUN, code JDUN, and then save yourself on this one. Fastest payout option is going to be Tradeify. They're 45% off the straight to funded. You just have to really focus on not having too large a days with that 20% consistency. JDUN. JDUN, aka DOD. All right, Mr. Gene's gonna take over for a sec. Gene, tell these people to be disciplined. I gotta use the restroom. I'll be back.
What's up, guys? What's up? What's up? Whoo, what up, guys? I'm dying. I just moved a bunch of couches by myself. What up? Where are we at on NQ? Damn, no way. Let me see what my entry on those longs were. I was not supposed to trade, but I did. Let me see. It's not my phone. Where's my phone? Let's see. I don't know. What's it?
How's the carpet going down there?
I just moved those couches by myself.
Is he really? Is he ripping shit out yet?
Yeah, it's already all ripped out except for where the living room is.
Oh, wow.
Yeah.
Is the new carpet here yet?
No. But yeah.
Are they still here?
Just him?
Oh, where's the guy with the carpet?
I don't know. Hi. He made me move those couches by myself.
Oh, damn. Good thing you're a very strong boy.
That's not what you can say, but okay. That's not what it's supposed to
Jdun don't respond to me. I'm not using code Jdun. I'm sorry. Depends. Apex if you want scalability. Funded Next if you want a more beginner style account. So that's not as scalable, but some people favor the rules. Nope, no consistency on the funded. There's no consistency on the funded. It's only on the eval. A lot on my mind. You want to scale and get paid, then Apex is best. Well, let's see what they do here. If you don't need immediate payouts, I mean, it just depends on what you like for rules. I always say prop firms aren't one size fits all. If I had to choose a direction right now, it'd be shorts. That changes if we get above 241, though. Well, it's FOMC. We're chilling. I don't always trade power hour. I do sometimes. Yeah, I prefer shorts right now too over longs. We'll see. That can change over pre-market low. I think you got a good thing going with shorts. All right, let's see what they give us in the next. Just a little bit. It's looking like we want to flush right now based on price. Over 2, I thought you were a good trader. Yeah. God forbid you lose a 14-point trade and a 10-point trade. You're horrible. So when I'm 2 for 2, the usual, I'm the best, right? I'm the GOAT. FOMC for the afternoon sesh, baby. Come on. No. Not even a little. Why would I get tired of the trolls? They come in here and comment and they boost our algorithm so more people see it. More people see it, more money I make, and more people I get to help. So, you know, it's a win. I pray for them. I mean, no one that's really happy. Like, no grown man is in a TikTok live hating. If you're a grown man and that's what position you're in life, and we need some serious reevaluation. You feel me? So it is what it is, baby. I pray for them. I'll help them make money. I'll change their mindset. If you don't have people talking about you, you don't have haters, you're not winning. Yeah, how much on Apex? 50 rack payout, baby. $50,000 payout from Apex. The best, most scalable prop firm. Still my favorite. And code Jdun will get you, well, I think it's not 80% off anymore. It was. Is that a salmon in, Mr. Gene? Yep. Thank you, sir. Appreciate you, bro. Damn. That actually looks like a strong buy candle. It's just tough because we're at pre-market low. This definitely looks like a higher low right here. Based on the swing low, higher low, higher low. Maybe a little retest back down, then a move up. We'll see. Market closes in 20 minutes, y'all. Market closes in 20 minutes. I'm not in any positions right now. Just watching. We also have Meta and Google earnings after hours as well. Should have sold Bitcoin today. Why? We're not at 1 million yet. Did I take shorts? No. Let's see here. We're still below pre-market low. If we can't hold this area right here and move up, then we likely will just chop. If we get some aggressive move breaking structure down with higher volume, then we can potentially look for a move down. But right now, as we go back and forth here, I have no interest in putting on any risk. Oh. Whoops, there we go. My bad. I don't know why it does that. I full port, so we move. Right. We full port a few mil into some longs. DOD. Someone probably hope not. Please don't full port longs. Please don't. As a reminder, guys, our main trading stream is every morning at market open. So if you're looking to have more discipline, more focus, and get closer to payouts, make sure you tap in and join me every morning, 9:30 a.m. Eastern time. Hit that follow button on TikTok. Make sure you guys have your notifications on YouTube. They're really about a pump, huh? I learned from a few people. Umar was one of my main inspirations, though. If you did full port, though, look how that's working out. Oh, we're on it. Always. We got MOC in 4 minutes as well. How was everyone's day, Team Bull? How'd we all do? I've been on some massive winning streaks, but I don't really care about winning streaks. I care about process streaks. Yep, appreciate y'all hitting that follow button, hitting subscribe. Facts. Ever since I started focusing on discipline and not P&L, I've had green months consistently. Saul chose discipline over dopamine. That's why you see so many of our traders getting payouts. We're growing our live streams every day because people are seeing results. You're seeing what it takes to make it in trading. And I'm doing my best every day to come here and tell you guys, hey, be patient, stay calm, stay focused. Choose DOD. I was just marking out swing highs and swing or swing low and then higher lows. Kind of looks like we want to pamp low key. Would I take a long over this high? We would need some pretty solid confirmation. Kind of looks like we want to pump, though. I could see a good old-fashioned pump in the high a day. I could see it. If we get a strong close on this candle, the last 5 minutes, you want a super high risk trade. You wait for the pullback down to like 255, 250 area, and just nuke the longs with stops below like 25. That's what you do. And of course, you have your risk defined. We also have some massive earnings after market, like massive. Let's go watch the NQ 1 minute chart too. Jdun the Dawn, what's up, bro? What's up? We want super ultra mega pump. Super ultra mega pump. Come on. Seven more minutes of market, then we have mega earnings. Mega earnings. Is this the balance area? Do we try it? I want to see this candle close first. This is the area I was looking at. It was like 250 down to like 240. But if we close this candle super weak with this wick, then that invalidates what I'm looking at. I think I'm better off probably just not trading these last 10 minutes. I do like the idea of that 250. I did. Still watching. You're still a fan. Let's see here. Let's see what it gives us. I'll use POC a little bit, but not a ton. And right below the 15-minute low. Damn, let's see. It's gonna end up that idea is gonna end up working out perfect, huh? That 250 area was the one. But we have 3 minutes left, so I'm chilling. We're chilling. I think tomorrow we're going to get a banger trade, too. I love the day after FOMC. We also have some very big earnings tonight, too. So we should either get a massive move up or a massive move down, which will make for nice trading conditions tomorrow. If I had to full port the last 3 minutes, I'd full port long. Ugh. If I had to choose. Appreciate y'all being here. Make sure you tap in and hit that follow button. I trade live here every single day and market open. I better see all y'all either A on TikTok or on YouTube. I'm on both. You also have a Trump meeting about tariffs with China. Yep. Appreciate you guys using code Jdun with any of the prop firms listed below in the description. If you're looking to get funded, those are the firms that I trust and I have partnerships with. Alpha Futures and Funded Next are similar to Top Step. Tradeify is straight to funded accounts. And Apex is the most scalable. I never trade Asia. Occasionally. Ain't gonna follow if you don't help your chat. I help you guys every day. What do you mean? I don't think it's more so about what account size, but what can you handle. I would personally, I like the 50Ks if you're just getting started. All right, y'all. Oh, wow. Look at that. Look at that. Pump. Well, that full port long would have worked out nice. That would have worked out real nice. Damn. All right, y'all. I'm going to get out of here. Trade smart, trade safe. Good luck, everybody. If you're just getting started, a great deal right now is the Funded Next accounts. Oh my gosh, look at those longs. Would have went crazy. All right, y'all, I'm out of here. God bless y'all. See you in the morning. Be smart for earnings. I got to go get some stuff done outside of trading and business, so I'll see y'all later. Peace. 9:30 a.m. Eastern time. I'll see you guys live here. Hit that follow button. Tap in, and let's learn and level up together. If you celebrate earnings, if you trade earnings, just be careful. I'll see you on the flip side. Peace.